Let's be honest here. Topics around finance and investing can be a little boring and a lot difficult to understand for the everyday investor. And perhaps that's why the use of sporting analogies can be a great way to explain complex ideas in a more relatable and understandable manner. In this video, we shall look at 5 such sporting metaphors, 5 comparisons between sports and investing. And if you like any of these, be sure to mention it to your friends when you next meet up at your favorite sports bar. So on your marks, get set, and let's begin. A football team comprises of 11 players on the pitch, a goalkeeper, defenders, midfielders, and forwards. Now each of these players have a specific role to perform, and the more efficiently every player in the team performs, the greater shall be the team's success. Much like a team formation, your investment portfolio too needs to have different assets, with each asset playing a diverse role. Your forwards are your flexi cap, mid cap, and small cap funds, along with your growth stocks, whose focus will be on scoring goals. Your midfielders are your large cap, gold, and hybrid funds that will keep possession and will provide stability to your portfolio. And then there are the defenders and the goalkeeper in the form of debt funds, bonds, and cash, which will look to cut down the risk, especially during turbulent times. In essence, the right asset allocation is the operative word, and one should aim for a diverse mix of assets in their investment bucket. The reverse sweep, the ramp shot, and the switch hit. These are 3 shots that might be very good to look at, but their execution comes at a very high level of risk when compared to the returns they offer. Much like a game of cricket, successful investing hinges in being on the right side of the reward-risk equation. In fact, the investing version of a reverse sweep are situations when the valuations are obscenely high, when the credit quality of the bonds are falling, or when you buy penny stocks on a hunch. In other words, these are situations when you really don't know what you're doing or whether what you're doing is going to lead to a successful outcome or not. But having said this, there can be times when the odds are in your favor, that is, the return per risk is on the higher side. This typically happens when there are 2 things coming to your advantage. Firstly, your downside risk is limited, and secondly, you are investing in a situation where you have a large margin of safety. Let me explain this with a simple example. So say you go to a gift shop and you're looking to buy a wallet. Now there are many wallets in that shop and all of them have a fixed price of 400 rupees. While you're checking out some of the wallets, your eyes fall upon a particular wallet which has a green piece of paper sticking out of it. And when you examined that wallet, that piece of paper that was sticking out happened to be a 500 rupee note. So if you build this situation around a risk-reward equation, we can see that the odds are now completely in your favor, because for 400 rupees, you not only get the wallet that you anyway wanted to buy, but you also get to keep the 500 rupee note. In other words, your downside is limited, and more importantly, your upside has multiplied. These are the kind of odds that you as an investor should aim for, and simultaneously do yourself a favor and always avoid the extremely risky shots. Back in 2004, when Novak Djokovic became a professional tennis player, he was ranked 680th in the world. It wasn't until 2011 that he became the #1 ranked player in the world, and as expected, he climbed the rankings by winning more and more matches. In fact, in the 8 years between 2004 and 2011, Djokovic improved his match-winning percentage from 40% to 90%. But what's really remarkable is that for Novak to jump from 40 to 90%, it did not require a commensurate increase in the points won. What's amazing is that Novak had to win just 8% more points to effect a 50% jump in the percentage of matches won, which in turn took him from being the world's 680th ranked player to becoming a world #1. Now, I'm not suggesting that an 8% jump is easy in any way. In fact, it's incredibly hard. But what Djokovic really did over those 8 years of ascendancy was to take control of all the tiny little decisions he needed to make correctly in order to improve the odds in his favor. These tiny decisions included things like his mindset, the goals he developed for himself at a young age, his diet, his practice routines, his stamina, analyzing games, and many such marginal improvements. This is what we refer to as the winner's edge. And the investing version of the same will include small acts such as setting your financial goals, asset allocation, rebalancing, gaining more and more knowledge, reviewing your portfolio, not speculating, investing for the long term, etc. So remember, much like the Djokovic journey, your path to wealth building is not about taking one big swipe, but is an aggregation of the small things that you do on a daily basis. And yet another thing you can do right now is to subscribe to our YouTube channel. And if you like this video so far, don't forget to share it with your friends and connections, especially the ones who enjoy making money while watching their favorite sport. It's the last week of August when we are recording this video, and the Indian openers have played the English fast bowlers rather well in the first two test matches. KL Rahul and Rohit Sharma have both taken their time to settle in, and the standout feature of their batting has been their awareness to leave any away-going balls that have been pitched outside their off stump. In other words, they have been very selective of which balls that they want to put their bat on, and it makes perfect sense in a 5-day test match where there is no real urgency to score fast. This approach to test match cricket is how good long-term investing should be. And in our case, instead of the English bowlers, it is the stock market that keeps on throwing quotes at every second. Reliance at 2000, Infosys at 1700, Britannia at 3800, and so on. And just like you don't have to swing your bat at every ball that is thrown at you, you really don't have to frequently buy and sell stocks to build your wealth. Instead, you can be super selective, and you can choose which stocks to buy. You can have a target price at which you want to buy or sell. You can decide which sectors you are interested in going after. And if you don't understand any of this stock market mumbo jumbo, you can also choose to leave it to a professional fund management team who will do the necessary research and execute the transactions on your behalf. So be smart, do what you understand, and if you're not sure, please be prepared to leave all balls that land outside your off stump. A football season in most leagues around the world is 38 games per team. A win gets you 3 points, a draw gets you 1 point, and of course you get nothing for losing a game. And the league winner is the team that has the most points at the end of the season. Which means, what's our objective here? Yes, we need to score goals, we might need to win some matches, but the real objective to win the league title is to win points. Now say your team has a very strong attacking lineup, Messi and Neymar and Mbappe, which means you will score a lot of goals, but if your defense is weak, then even if you score 4 goals in a match and your opponent scores 5, you will end up with 0 points. Okay, now let's try the reverse. So say you have a very strong defense and your team does not allow a single goal the entire season, which means the lowest result you can achieve on every match is a goalless draw. Remember, a draw means 1 point, and by that logic, 38 goalless draws means 38 points. And while 38 points will not win you the title, there is little argument that a football manager sleeps better knowing that his defense can be trusted to protect the downside. In fact, there's a very old saying in football that reads, "Offense will win you games, but defense will win you the championship." And the last 17 years of data really proves that, with the Premier League winning team of all but 1 year also being within the top 3 defenses in the league that year. Now, like it is in football, investing too assigns a higher value to your portfolio's ability to defend rather than attack. Let me explain this. If your portfolio were to go down by 10% today, then for it to come back to the same level, a 10% rise will not be enough. In fact, a 10% fall needs to be compensated with an 11.1% rise in value to get back to parity. Similarly, a 20% fall will need a 25% jump in value, a 30% fall will need a 42.9% rise, and so on. So remember, if you take a loss, then you will need to work a lot harder to come back to the same level, which means you need to be more careful with the decisions you take with your money. Don't speculate, don't be careless with your expenses, and ensure that you always put your money to good use. And with this, we come to the end of this sporting presentation. Like it is in sports, so it is in investing, and good outcomes are a function of the processes we put in. In sports, it comes down to training, diet, strategies, coaching, mental conditioning, and deliberate practice. And in investment, we have SIPs, asset allocation, rebalancing, understanding of risk, curbing harmful investing behavior, and some specific strategies from time to time. If you want to know more on how to master the investing game, then do subscribe to the ETMONEY channel and access our growing repository of videos on investing and personal finance. Don't forget to share, don't forget to like this video, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.